Welcome back to Mostly Growth, the #1 podcast in product monetization. How are you guys doing today?
Yeehaw!
It is the Wild West with AI valuations, huh?
You can just make up numbers now. This is crazy, Kyle. It's like, pick a card, any card.
Well, so you can't make up numbers because companies they're doing a modest $965 billion valuation, not a full trillion. So can't just make up any number.
We're going to get into it. I actually thought that this was low. They could have easily reached for the T handle on this one.
It's almost like they like wanted to get close but not hit that number. It's like,
Yeah.
No. Well, there's still room left above this valuation.
Yeah, they wanted to leave a little bit of extra headroom, some meat on the bone, and to show a little bit of restraint. I don't think OpenAI would have done that.
We're talking about Anthropic's big fundraise at $965 billion. They've also confidentially filed for IPO, although not that confidentially because they did a press release about it. Which I want to ask you about. So we'll get into all things, but we also want to know about like who's making money from all of these mega rounds. Like there's a lot of money changing hands here. So how are the VCs getting paid? How are the bankers getting paid? Are employees actually getting paid? We want to get into it.
I'm excited to talk about how the money is moving here because it's not just Anthropic who is putting money in their bank account. There's a whole ecosystem.
Totally. Before we get into that, so these are a lot of the people we're going to be talking about, I suspect, are avid golfers. I was in Europe this last week for a conference, and I found out a really fun fact about Germany. Do you guys want to hear it?
I'd love to.
They require you to have a license in order to play golf.
A driving license?
So it's called Platzreife. It seems like it's kind of like a driving license, although now I see what you did there with the pun. So
I didn't even realize I did that. And I'm the king of dad jokes. Wow, I stumbled into that.
A driving license?
Driver's license off that tee, but you have to pay like $300 for a 5-day course that involves like hours of training. Then you have to pass a bunch of tests. You have to complete an 18-hole course at a max score of 108. But what I'm wondering is like, if you have to do that just to play golf, like how do you get good enough at golf to pass the test in the first place?
This is the most German thing ever, by the way.
It's so weird. We were talking a lot about regulations and, businesses in America versus Europe, and that one just blew my mind. But apparently it probably means there's really good business for all the golf courses right on the border of Germany.
Right, because like where do you practice? I suck at golf. I could not break 108. I know it's embarrassing to say out loud.
You wouldn't be able to pass this test? Ben, could you pass this test?
108, you said? Yeah.
Yeah.
How many breakfast balls do I get?
It's Germany, so none. I was on the high school golf team, so I think I still got 108 in me.
Did you golf when you were out there then?
I did not golf when I was there. I hung out by the beach. The conference they promised sun, sea, and sass, and they did deliver on all three.
Oh, I thought you were going to say they're 2 out of the 3.
No, it was all three.
From Mostly Media, it's Mostly Growth. Go-to-market strategist Kyle Poyer and CFO CJ Gustafson break down how modern companies make money, covering pricing, monetization, and benchmarks in ways that make you better at your job. Tactics and playbooks for finance, product, and sales operators looking to be the CEO of their role. This is Mostly Growth.
Let's get back into all the people that are playing golf in America and playing at these fancy private country clubs now that they've made all this Anthropic money. But first,
I love when you link up what we're talking about. You're the best at the transition, Kyle.
Thank you. I'll take all the compliments. So Anthropic, one thing that's confusing me, in like a week, they announced the big fundraise and then they announced the confidential IPO. Why not announce these at the same time?
This is very normal. This is super normal to do one last big fundraise to get your anchor investors for your IPO. So if you look at like SpaceX, the round that they did prior, those are going to be the companies who are going to get in at a great stake. And what you're doing is you're essentially giving them like a discount because the business isn't going to fundamentally change all that much. I say that now, but Anthropic didn't they add remember when they added like $20 billion in like a month? So this is probably the only business that could change fundamentally that much. But what you usually figure is within the, let's say 4 to 6 months leading up to the IPO, you're probably underwriting the same base case in that company. So what this is kind of like a hat tip to the companies who are going to sign on and take on those bigger blocks of capital commitments that are going to have to go in, which allow you to start building the IPO book in a fashion that makes like life easier.
So all right, just get this straight. So these are people that are coming in, they're doing a private investment, but they're also kind of committing to a public investment.
Yeah, I have no doubt in the world that they had to commit to also buying in at some price down the road. But like, let's just round up to $1 trillion here. Let's say they're coming in at $1 trillion and then they IPO at 1.5. They're getting the benefit of like a 50% like increase to IRR like on day one, which is pretty nuts. But they're committing incredible swaths of capital in order to do it. And that's another reason why I think that this was somewhat of a muted number. I can't believe I'm saying that about 965 billion. But it's because you're giving these guys a leg up to get in before the IPO.
Yeah, so they're getting some sort of incentive here, which in some ways makes sense, but in other ways, like the numbers are just so massive. It's all kind of it's all bonkers to me. But this is why they maybe didn't want to even go for that $1 trillion valuation.
Right.
So who led that round? Who were the key players here?
Dragoneer and Altimeter were two of the largest ones. And those are crossover funds. A crossover fund means that your LPs give you permission in the funding docs to invest in both private and public companies. And so what they're doing is they're coming in before a company goes public. They invest in companies that are like past the what you would call growth stage and are now later stage but still growing well. Like many of these investors who are on this cover or just did that round were also in the likes of like a Snowflake before they went public. They'll probably be in the likes of a Databricks. So they are not the mutual funds of the world like a T. Rowe Price or a Wellington, but they're one step before and have the flexibility to do both private and public investments.
They're funds that have big pools of capital available. They like late stage private investments. They can also stay with companies in the public markets. They're probably registered investment advisors, if I had to guess, based on this, which most VCs are not registered investment advisors to invest in sort of private early stage companies. You don't need to be. Once you want to do things like a lot of secondary deals, more public market investing, by registering, you do have a lot more requirements and it's a lot more compliance work for your team, but it gives you a lot more flexibility of how you can deploy capital.
Yeah, I'm glad you brought that up because even if like something looks super attractive to an early stage investor, they may not be able to go and invest in that.
Yeah, we had limits in how much of the fund we could invest in different areas like secondaries until we made that change. But I have to say, from a marketer's perspective, the change to being an IRA is so painful. I feel like marketing got hit among the hardest of all the teams.
Just to go on a quick tangent there, why? So you can't market yourself anymore?
So you can market yourself, but like your team goes on a podcast and talks about how great your firm is or your returns or anything like that. You all of a sudden have to disclose that as an advertisement to the SEC. Everything you do that has a public statement, you have to be monitoring. You have to get out ahead of it. You have to be careful what you say because if anyone on your team says something that's untrue or could be misperceived as like an ad for capital, there's a lot of potential scrutiny on that. This is years ago now, but my interpretation was we didn't change that much of what we did. We just had to be way more compliant around keeping track of it all and getting ahead of it.
Okay, I get it. What should we hit on next year on this one?
Well, so one thing that's confusing, so Altimeter, they're one of the headlines. I think they were the first ones mentioned in the press release, which to me usually means you have to put in the most money if you're going to be the first in the announcement.
Oh, I thought you were going to say that means they're alphabetical because it's A.
Actually, that's the other interpretation. That could be. I was going to say that's normally the firm that puts in the most money. They want to be the first author essentially, but it's possible it's alphabetical. Yeah. Now, their AUM is only $20 billion. And I say only, that's a big AUM, but that's actually like peanuts relative to the size of this round and how much capital Anthropic needs. How does that work?
Well, there's a good chance that they took a bite of it in one fund and then maybe another fund and then also raised an SPV. So it's a special purpose vehicle. And what these larger hedge funds will do is they'll go back out to LPs and be like, hey, we got a chance to get back into Anthropic again. Do you want to give us more money? And at that point, people are like, oh, you have access to that? Nobody else can get access. And you can raise this side pocket fund. So if if you're not a CFO, you may not realize that you may raise from like Andreessen Horowitz, but on the cap table, it's like 4 different funds from Andreessen Horowitz and also an SPV. So these can take different forms. And even if the AUM is one number, it doesn't mean they may not opportunistically go out and try to gather up some more cash.
Hey, thanks for listening. We'll be right back after a word from our sponsors.
When I went all in on my newsletter, Growth Unhinged, last year, I quickly decided it was time to make the switch to beehiiv. I chose beehiiv because they're serious about powering the internet's best newsletters. beehiiv's all-in-one platform brings together newsletters, websites, and every tool you need to grow and earn. And they keep making it better. You can now launch, host, and monetize your podcast entirely on beehiiv. You can host webinars on beehiiv. And you can access beehiiv through the new MCP. I just use beehiiv's MCP in Claude Cowork to audit my site, prioritize SEO fixes, and analyze subscriber trends. It's my newest obsession. If you care about owning your audience, beehiiv is a no-brainer. Try beehiiv for free by going to beehiiv.com. That's beehiiv.com. Use Kyle30 for 30% off your first 3 months.
Ali and the team at Tabs are building something that directly addresses one of the biggest headaches I see finance teams deal with today. Pulling data from your ERP, your CRM, your FP&A tools, and your usage systems and actually making it all work together. If you're running usage-based pricing or complex contracts, you already know how this usually plays out. Contracts live in one system, usage data lives somewhere else, billing happens in another tool. RevRec gets layered on top at month end, and finance ends up just reconciling everything by hand to close the books. This is exactly the problem Tabs was built to solve. Tabs is an AI-native revenue platform built for controllers and CFOs. It brings together data from your ERP, CRM, and real product usage into a single system of record. From there, it automates billing, collections, and revenue recognition without finance having to duct tape workflows together every month. If usage-based revenue is core to your business, this is the future of how billing and RevRec get done. Go check them out at tabs.com/run. That's tabs.com/run.
When I looked to set up my first CRM at Growth Unhinged, I knew I wanted something that was actually AI first. The world has evolved. Most CRMs are still stuck in the 90s. I found Lightfield, the CRM that remembers everything and does the work for you. It joins all my sales calls, reads my emails, and has the full context on every account. At this point, Lightfield knows my deals better than I do. I haven't had to set up a single CRM dashboard. Instead, I simply ask Lightfield questions like, which deals in my pipeline are most likely to close, or who do I need to follow up with today? It even automatically prepares me for meetings with a personalized daily briefing, and setup was quick and surprisingly painless. Lightfield is my sales coach, RevOps analyst, therapist, EA, all in one. See Lightfield for yourself with a 14-day free trial. Connecting data from your inbox takes just 5 minutes, and you can migrate in under an hour. Go to lightfield.app, that's lightfield.app, and use code MOSTLYGROWTH to get 3 months free. Yeah, so these SPVs, they're very popular, I'd say like in 2021, 2022, when you're an early stage fund that does a seed and you see your portfolio company start to raise a B and a C and a D and an E. And if you were to participate at your pro rata in all of those rounds, you basically deploy the entire fund into one company. But you also don't want to decline because it's a company you have a high conviction in. Your investors really like it. Like there's a great VC that's underwriting this next round and did all this work. So it's like, why not deploy capital if it's being underwritten by all these other firms? And so it's a great thing that firms can offer their LPs, because the LPs might be university endowments or pension funds or like all kinds of pools of institutional capital. And for them, these are the companies that they would want to get into, and they can get in at a lower fee usually compared to investing in the main fund.
To Kyle's point, they have a fund strategy of how many bets they're going to make. And they may say, well, we're going to invest in companies where we'll put in between 500 and 100 million per company. That would be on the big side. These checks are so large that instead of being able to make 20 bets or 12 bets in the fund, it's like, dude, you used up all the money on Anthropic. Now there's no diversification at all. And this is actually different than what we had in the LP agreement, where people were underwriting us to make at least a range of investments here. So you can't gobble up all the capital then. However, like you said, this is a great opportunity. We don't want to pass that up. So how about we take maybe a smaller, medium bite out of it here to give our LPs access But so we don't overweight our fund and upset the entire structure, we go out and raise this SPV on the side as well.
I have to imagine this is either like majority SPV capital or like that's involved in the mix. But what have you seen? What have been the fee structures on these SPVs? Because I think part of the value for LPs, so venture funds known for charging 2 and 20. So 2% management fee on the capital. That is an annual management fee for a certain number of years and then normally steps down at the end of the kind of fund deployment cycle. But that ends up being pretty expensive capital. So you got the 2% fee for at least 5 years. And then you've got expenses that are on top of that you can bill your LPs. And then you take 20% of the profit. And if it's a top tier fund that's had great returns, they might be taking actually 25 or 30% and not 20%. So like venture is a very expensive asset class for LPs. So I have to imagine these SPVs. If you're going out and raising a $10 billion SPV, you're probably not taking 2 and 20 on that, but you probably are taking something. What have you seen there?
I was texting a friend about this morning because I was like, all these someone had, it was related to something different. Somebody asked if I wanted in on a different SPV. I wish it was Anthropic. It wasn't. What I got back is that a typical range for an SPV is closer to 1% and 10. So 1% management fee each year, 10% on the carry. Because it's only one investment, right? Like how much admin work could that possibly be? But the ideal structure is probably, and this is where it's like a moving target, no fee at all, but 15% carry.
When we're talking this size of an investment, I would not be surprised if there was no management fee, like if they still charge for expenses, but even a 1% management fee, if it's like a $5 billion or $10 billion SPV,
How much is that?
That's so much in terms of fees. I'd have to imagine that they're taking some carry on it, but probably not management fee. But then that carry is worth so much money. So like if Anthropic goes from worth $1 trillion to $2 trillion, this
Get
fund
20%
has
on
raised
that.
this SPV. It's kind of like free money on top
You're in the
of
money.
all of their existing fund.
And that's what I was saying around getting in before the IPO. Like they're way over their hurdle rate for carry immediately.
The downside is reputational, right? Like they make this investment, it does poorly for the firm. It might, make them look bad in front of LPs. But realistically, like there are different pockets of money. So the fund performance is not impacted. But like if the company goes to zero, then it's just, hey, we didn't make any carry on this SPV. Then if the company does well, they make all this carry money on the SPV. Now, I think that to manage that, a lot of times the founders of a firm like that and many of the partners will invest their own personal capital into the SPV as a signal that like, hey, we believe this, we have a lot of conviction and skin in the game. We're not just trying to sell you, our dear LPs, another product that we can then make money on.
But it's important to pause to say these AI IPOs are an amazing opportunity for capital agglomerators, we'll call them. So they're just taking as much money as possible and multiplying it by 2%. Yes, of course they want to make a good return on it, but like if you can get a guaranteed 2% of $1 billion, what is that, 20 million a year? Just in admin fees? Am I doing the math there right? Like that's pretty good living, especially if you don't have a ton of overhead. And there was a rise of these types of funds during the COVID craze where like the likes of a Tiger and stuff, they're like, you know what? We're totally cool with I'm just making it up, 18% IRR. Like it's going to be under 20%. We're going to basically get a ticket to the show to index the technology sector. But like the real game here is get it raise as much money as possible and get 2% management fee on it. And that can be worth more than some of these cottage funds that are smaller. Maybe they're only 200 million. And the 2% on that can only feed so many mouths. They really need to hit it big out of the park on their returns. So there's this relationship of what you're balancing. Are you built for the management fee or are you built for the return? And it's also harder to get a higher return the more money you have to put to work.
Do you think Tiger took a 2% management fee?
Yeah.
I thought part of their pitch was that they wanted to be a cheaper source of capital for LPs. And so they had a leaner model. They would invest a lot of money, but would have a lower cost of capital. And then it would be more like an index fund on the venture market, late stage venture, rather than being like the premium niche, like we're going to do the most underwriting and most value add for these companies.
I mean, maybe I'm wrong. Maybe that is the case, but either way, they raised a ton of money. And even if it was 1.5% against that, that's still.
Either way, your point holds. Like the strategy here is so different from what people think of as traditional venture. Like traditional venture, a seed fund historically has been relatively small. Like we're talking a lot of fund sizes are under 100 million, especially if it's a solo GP fund. There's not a ton of management fees if you have a sub $100 million fund relative to all the costs of running a fund. And then when you look at the returns are, hey, we got in at really low valuations because we like had an access advantage to this company when they were just getting started. It maybe takes 10 or 15 years for the companies we invest in to exit, but there's a lot of upsides because we're getting in at a low valuation. Like I think that's still in people's minds what venture looks like. But the game that a Tiger or Altimeter are playing are so different. Like they can get really rich on the management fees alone.
They can get really rich on it. And what people don't know in the background is there are a lot of secondaries that go on, but it's not secondaries in individual stocks and companies. It's actually secondaries in the underlying funds. So you're buying a piece of the fund and you can either buy the carry portion of it, like you're taking like a chunk of whatever the portfolio was off their hands, or you can actually buy into the management company, which means you're getting this 2% annuity stream and access to that. And like when you think about like succession planning for a lot of these companies, yeah, they care about the carry and the interest there, but like the founders really care if they've been able to get so much capital over time, like the ownership of who gets that 2%.
If you're at one of these venture firms that has a hot portfolio, the reality is like for a lot of the people that work there, it is a long vesting period of your carry dollars. So it might be 5 to 10 year vest that people have to manage. And so it kind of locks you in. Like if you're at a VC that has a hot portfolio and can keep like deploying more and more capital against an existing portfolio, you want to stay because you're going to have your carry vesting and you're probably going to have multiple funds vesting at the same time. And it is really hard to walk away from that vesting, even if you don't like the partners, don't like the firm. But it's also one of those things that like if the companies start underperforming and you're not going into carry territory, all of a sudden the incentives start to move in reverse because why stick around if you don't have carry that's really going to be meaningful dollars? Why not do something that you find more enjoyment out of?
Kyle, I didn't realize the vesting period was that long. I figured it was 4 years, just like working at a tech company.
It is really long, and it's because the hold periods on these companies is so long. I mean, when you're investing in a company, it could take a very long time for that company to have an exit that returns dollars to shareholders, and you don't want people to leave before the next event has happened, because then how are you going to motivate that new hire to replace them? That 10-year vesting, a lot of that is more common in early stage funds. On the funds that look more like an altimeter that are doing public market investing too, they might look a little different. So they might have maybe a number of like maybe carry dollars vesting as opposed to like a number of years and percentages. So some of the mechanics will look different for later stage firms.
I have a friend, he's probably like 42, 43. He's at this European secondary firm, and I think they've had 8 funds over the course of its lifetime. To your point around like a difference in fee structure, if you're doing secondaries, it's a lower fee structure. He said they're 1 in 10 or 1 in 15, something like that. But he's been there his whole career, legitimately. He's been there like 20 years. And so he's like, I don't know any like life outside of this, but also I've been here for now going on 5 funds, Kyle. He's like, I physically like can't leave. Like I would love to go do something else, but every one of those funds, my economics have gone up a meaningful amount. And I'm going to get to a point where like, if I can stick it out 5 to 8 more years, I'm just going to start getting checks in the mail when I'm 70 years old for these companies that sell that I had a larger portion in. But it really made me think like, oh, you think golden handcuffs are one thing at a tech company? This guy's like, I just can't, like this is where they're going to bury me.
Yeah, you're like if you're getting promoted, you're getting maybe a higher percentage of the fund economics, and the fund size is growing up, and you have multiple funds vesting at the same time. Like
that's
it
what
really
he said.
can be an
he has 3
exponential
funds.
increase.
He has 3 funds vesting at the same time right now.
Yeah, that could be worth a lot. Or if this is all a bubble, it can go to zero really quickly. All right, so we've talked a lot about the investor side. Now, employees, have they made money from Anthropic yet? Have there been a rush of expensive home buying in San Francisco yet?
I've heard it's very hard to get a home in San Francisco right now. There are like 3-bedroom places going for like $2 million over asking.
I'm so glad I don't live there. But they did have a secondary, and I thought very few people took them up on it, right?
There have been multiple opportunities to cash out for employees. OpenAI had permitted 600 current and former employees to cash out up to 30 million each in a landmark 6.6 billion secondary share set. Dude, that is such a big number, 6.6 billion. I had heard anecdotally that 75 people hit that $30 million threshold.
That's a nice paycheck. Now, so compare that to Anthropic, and they did have a secondary transaction that I believe launched in like February of this year and
Yeah.
wrapped up in April. They were targeting 5 to 6 billion in capital that employees could cash out, but the valuation at the time was 350 billion.
It's almost tripled.
Yeah, if you're one of those employees and you cashed out in like March, April, 350 billion valuation, you were probably celebrating for like a day. And now you're like, maybe that wasn't such a good idea.
Yeah, that's a tough one. And that's like, there's been all this news about the SPVs that weren't actually board approved SPVs. And like, what is the game theory of like, if they're not approved, like as the employee, like you just give them enough cash to make up for it, like whatever they missed out at, but then like you get to keep the upside, like how will that work? And so the valuations are moving so fast. This is like the only time in history really that I can remember that it's like you're kicking yourself for taking the secondary.
So you think a lot of employees aren't taking up the formal secondary, but they are finding other buyers for their shares at different valuations?
Yeah, above that.
Very interesting. But then now, all right, so if Anthropic, they did confidentially file for IPO. If they go public in a few months, how quickly will the employees have liquidity? So if they've waited, how long is it going to take before they can actually sell their shares in the public market?
So just to take a step back, you always hear about companies filing for IPO in 2 waves. The first one is like Anthropic has confidentially filed for IPO. It's not confidential, like we aren't supposed to know about this. Like that's public. Like they made an announcement. It's not confidential in that sense. The numbers are confidential and the contents of the filing are confidential. And that's because the SEC gets a chance to give them comments on it to say like, hey, you're talking about your net dollar retention rate, but like you don't actually give the number anywhere. Or you don't have like a great bridge on your adjusted EBITDA here. Like you need to put that in, or you cannot credibly make that claim to the public. And so it's basically like a draft. That's what it means. And then what usually happens 6 to 8 weeks after, if they want to release it and they are planning to IPO, is that they will have quote unquote blessed filing, but it won't have the number of shares up yet and it won't have the price. Those go in at the very last moment, right before it goes live. So in that sense, actually, there are 3 different waves of like having this filed.
When's the roadshow happening and when's the quiet period in that process?
The roadshow usually happens 6 weeks before the IPO. But you have to have this filed before you start the roadshow.
When's the quiet period?
Quiet period. I would think they're in the quiet period now then. I don't know. I don't actually know that.
All right. I am asking the AI overview on Google. An IPO quiet period has 2 main phases. It begins the moment a company officially starts its registration process with the SEC and ends 40 days after the stock begins trading.
Got it. Yeah, it must be because Krishna, their CFO, just went on Invest Like the Best last week. So it's like, perfect timing. Got it in right before he filed. You got to chunk that.
Yeah, they probably did a wave of publicity.
But back to your question, when can the employees sell their shares? Typically 180 days or 6 months after they go public. So that's why there was such like the uproar over like Figma's amazing stock pop on day one, but it's like the employees are sitting there and they can't do anything about it, right? And then by the time the lockup ends, it's at 20% of what it was at before. So that's what can make it like a difficult conversation. And like you can kind of see it from both ends, right? Like if you're Anthropic, you don't want the top AI engineers to just walk on day one, right? That's not good for anybody. But on the other hand, you're like, if you look at, I think it's 14 of the last 18 IPOs, by the time the lockup expires, the shares are below what they listed at.
We'll have to stay tuned to see if these employees made the right call. I suspect they did by walking away at this $350 billion valuation, but a lot can happen between now and, 6 to 12 months from now. CJ, we talked about investors. We now talked about employees. What about the bankers? How much are the bankers going to make and how are they getting paid here?
So the bankers typically will make between 3 and 5% of the total amount that you're selling, which includes both primary and secondary shares that are exchanging hands. So there may be early investors that they're helping to get to sell. There may be CEOs and founders who are going to sell and they don't have to wait with the rest of the employees. So it's any amount that's being put up to float on the market, including what they call the green shoe, which can happen afterwards to help stabilize the stock price by selling more. It's usually around 3 to 5%, and it goes down the more you offer. So like if you're only doing an IPO to raise like 200 million, you're probably going to get a larger fee. But if it's like $1 billion, they're going to probably only have to pay 1%, right? Like I bet SpaceX, I bet their IPO, I bet the total fees are 1% or less rather than like a typical 5%. But if you're raising 500 million, you're probably going to pay 4 to 5%. That's the average. And that's split, by the way, amongst all the underwriters.
All right, so stack rank for me. Would you rather be an Anthropic employee, an investor like Altimeter, or the banker?
I'd rather be the investor because I'm getting in at a discount without having to do 4 years of service there. And the banker is a great job on this particular company, but at the same time, it's true outcome-based pricing. It is a sure thing, but it isn't a sure thing in terms of what the final price will be. I think I would rather be the investors buying in the most recent Series H.
This is a lot of pressure for the bankers to get this right. I just have to say, I would want to be an employee. Anthropic just seems to be a pretty cool place to work. These employees are going to be worth a lot, and then they're going to be able to go on and do incredible things after Anthropic.
This is going to be like the equivalent of having Harvard on your resume.
Better than Harvard. I don't know what's better than Harvard, but
it's Anthropic.
This would be like you're in a secret society at Harvard.
Yeah, you graduated top of your class at Harvard with like 5 degrees. We were talking about this in a prior podcast too. Like even if you were just like a middle of the road person there.
Yeah, even if you're like staff engineer, although nowadays you could be the former CTO of Workday and be a staff engineer. Or no, member of technical staff.
Oh, I wanted to point out one difference though for how the bankers are paid, Kyle, if I can. So bankers also get paid on M&A transactions. IPOs are fundamentally a fundraise. For an M&A transaction, that is also truly outcome-based pricing. It's like having a realtor and you're like, hey, I'm going to give you 5% to sell my house. You guys split it between buyer and seller. Usually for an M&A transaction, it's something between 1.5 and 3% of the total transaction volume, which you'll notice that's a lower percentage than I cited for the IPO. The difference is typically only one bank will work on the M&A transaction, which means they get all of it. So while it's a smaller percentage, it can be a larger pot of money because there are fewer banks who get paid.
Well, that does remind me, I feel like a lot of companies file to go public and then they get acquired, during that period. What are the odds that Anthropic gets acquired? Is there anyone who has the pockets deep enough to buy them?
There's quite literally, yeah, they have one path. That's like the funny thing. I remember like some of the COVID era companies, like you start to say these valuations are getting so big, like your only universe of acquirers are Google and Google. Like nobody could afford Anthropic. I think it would be impossible.
All right, CJ, we started with Germany. I want to end with Germany. I have one more fun fact I learned on my trip.
I can't wait.
Friend of mine moved to Germany. And when she moved, you have to file with your local state. What's your religion?
Why do you have to file for so many things? This is like government capture. Isn't that what it's called?
You have to file your religion, and the German government collects a church tax that's like about 8 to 9% of your annual income tax.
Every
Apparently
year?
you can opt out, but there's like a waiting period to have an appointment to be able to like convince someone you're not actually religious. So can you imagine having to register your religion with the government?
How do I convince you I'm not religious?
Gotta commit blasphemy, CJ.
Yeah, right?
Just show someone this podcast.
Mostly Growth is a Mostly Media production. Executive produced by Ben Hillman. That's me. Additional production by Steve Sarasoli. Nothing said on this podcast is intended to be business or investment advice. It's the sole opinion of CJ, Kyle, and Ben. Just some guys who love talking growth. Mostly. If you like this podcast, hit subscribe and give us 5 stars. It'd only take like 2 seconds and our algorithm overlords love it. Drink water, call your mom, and have a great day.